Good afternoon, everyone. We are going to get started. Thank you all for being here with us today.
Hi, everybody. I'm Attorney General Carl Racine, and I'm happy to be here to kick off today's webinar. It is no secret that there's a student loan debt crisis in the United States. Heck, we were in one before the pandemic, and now the crisis is worse. Indeed, about 45 million student borrowers owe nearly $1.7 trillion in student loan debt, and as many as 20% of borrowers are in default. Nationally, the burden of student loan debt is felt most acutely by borrowers of color. These broader national trends are reflected in the District of Columbia, where DC residents have some of the highest student loan debt in the country, and residents of color bear an unequal share of that burden. A 2020 report of the Richmond Federal Reserve concluded that although student loan debt has generally increased throughout the district, the increase in student loan borrowing and the increased rate of delinquency have been concentrated among those who live in low or moderate income areas, particularly east of the Anacostia River. Borrowers desperately need and deserve relief from the burden of their federal student loan debts. Student debt cancellation would be a critical way to provide some of this much needed relief. And I'll keep calling for the administration and Congress to take action on it. But one of the most important things we can do now is to learn how to get in control of student loan debt, just as we're doing at today's event. Today's webinar will provide helpful tips on how to help successfully manage student loans in anticipation of the COVID-19 release for student loan borrowers lifting in the near future. For more information about student loan repayment resources, you can visit my office's website at oag.dc.gov and search Student Loan Repayment Resources in the search field. Thank you.
Good afternoon, everyone. My name is Ben Wiseman. I'm the Director of the Office of Consumer Protection for the Office of the Attorney General. Since Carl Racine was elected Attorney General in 2015, we have made student loans a priority, and today's presentation is going to be, it goes towards these issues that we know are so important to so many residents. I'm going to turn it over to Winston Berkman-Breen, who's the Deputy Director of Advocacy and Policy Counsel at the Student Borrower Protection Center, who's going to run today's presentation. Winston is going to answer any questions folks put up in the chat. We also have received questions from folks in advance. To the extent folks have any questions after the presentation that we aren't able to cover today, you should feel free to reach out and file a consumer complaint at oag.dc.gov, where you can file an online complaint, or you can email us at consumer.protection@dc.gov. Winston, you can take it from here.
Great, thank you so much, Ben. So I'm going to go ahead and share my screen before I get started. All right. All right. So can you all see the presentation? Ben or Lauren, can you confirm?
Yes, I can see the presentation, but I also want to make sure a couple of people said that they can't hear in the chat. And so I want to make sure that if someone can let me know if they're still running into difficulties. Okay, I think they were able to click audio, so I think we're okay. Proceed, Winston, I'm sorry.
Great, no problem, and thanks so much. So again, thank you, everyone. My name is Winston Berkman-Breen, and I'm the Deputy Director of Advocacy and the Policy Counsel at the Student Borrower Protection Center, which is a nonprofit organization focused on alleviating the burden of student debt for millions of Americans. I'm excited to be here with you today to discuss student loans during COVID-19 and how to manage repayment. So thank you to the Office of the Attorney General and for Ben and Lauren for organizing this event and for inviting us to participate. So the student loan landscape is vast and complicated, and there's no way that we can cover everything that you need to know in a single hour session. We can come back and look forward to talking to your office about that. But what we're going to focus on today is what you need to know to navigate the next few months of changes to the federal student loan system, and also some general tips for repayment and for managing your loans. We're going to accomplish these goals first by talking about how to identify the loans that you have, and then we'll cover the current status of repayment for most borrowers during the pandemic. Then we'll go over income-driven repayment options, followed by a review of what to do if you're in default, and we'll end with a discussion on public service loan forgiveness, which I think will be very relevant for folks listening today. Before we dive in, though, I just want to stress that you are not alone. Student loan debt is a growing crisis in this country. The outstanding student loan debt has grown by over $1 trillion in the past decade. Its growth is far outpacing the growth of other types of household consumer debt, such as credit cards, auto loans, and housing debt. And it's also the second largest type of household consumer debt, second only to mortgage debt. The student loan market has high delinquency rates, which is a reflection of how many borrowers are struggling to make payments. Again, you are not alone. As the Attorney General mentioned, there are 45 million borrowers in the country, and student loan debt crisis affects everyone somehow. We also in the United States have a culture that doesn't really talk about debt. So one thing I also hope we can do from this presentation is that you can learn something about managing your student loans and then take it back and talk to folks in your community or in your household and help them with their debt as well. Okay, so before we begin the discussion, I think it's really important to level set and take a moment to talk about the different kinds of student loans that are out there and how you can figure out what kind of loans you have so that you know what will be applicable to you from this presentation and how you can move forward afterwards. So broadly speaking, there are federal loans and there are private loans. Now, there are two major types of federal loan programs that you're going to hear about today. The first is called the Direct Loan Program, which are loans issued by the federal government directly to borrowers. The second is the Federal Family Education Loan, or FFEL loan program, which are loans made by private banks as part of a federal program that ended in 2010. But there are still millions of FFEL loans that are out there. The same is true with Perkins loans, which were federal loans issued through schools, though that program has also ended. And then there are private student loans, on the other hand, which are loans that you might get from a bank and are not part of a federal program. So you might have a private student loan from Discover Bank or Sallie Mae or SoFi. And within these federal and private loans, there are sometimes different, within these programs, there's sometimes different loans. There are several types of direct loans or several types of FFEL loans that you'll see today. Another important way to think about the different kinds of loans is about who owns them. The federal government owns all direct loans and many types of FFEL loans, while the rest are privately owned. So this is sort of counterintuitive, but that means that there are some privately owned federal loans. So we'll talk more about that, but this distinction became particularly important this past year during the pandemic and the CARES Act relief for student loans. And you see it sort of mapped out on the slide in front of you. So how do you know what your loans are and who owns your loans? It's actually pretty confusing, and many folks don't fully understand where their loans are or what kinds of loans they have. And this is especially true because you might actually have the same companies servicing your federal loans, your month-to-month payments and who you interact with, servicing your federal loans and servicing your private loans. So for instance, Navient is a servicer that you might work with for both of your loans. And so it might not be very clear when you're talking to them which loans you're actually talking about. So to see all of your federal loans, you can log in online at studentaid.gov and download your loan data. So you can see on the slide here how to navigate. You can go to studentaid.gov. If you don't have your login information or don't have an account, you can set it up or have the information sent back to you or have your password reset. And then you can go from the dashboard to the view details section. And then on the top right of there, download your loan data. So once you see this list of federal loans, there's an example in front of you from that download. You can see both what type of loan it is, what type of federal loan it is, and who owns it. So we see with this example here, with the first arrow, it says loan type FFEL Stafford subsidized. So this is one of those FFEL loans, those older loans, and the subtype is a sort of Stafford subsidized. And then at the bottom at arrow 2, we see current lender, U.S. Department of Ed. So that's U.S. Department of Education. So that's how we know it's a federally owned loan. The U.S. Department of Education is the current lender. All loans that are owned by the federal government will say U.S. Department of Education. Whereas on this example, we can see at the first arrow that the loan is a FEL consolidation loan. So that's still the same old FEL program, but a different type. But then down at the second arrow, we see that it says current lender US Bank, so not the Department of Education. So we know that it's a privately owned federal loan. Now this data you can download to reflect all of your federal loans, no matter who owns them. So if you have loans that you know about, that you either interact with your servicer about, or that you get statements for, or that you've checked your credit report and you see listed there, and they're not showing up on this list printout, this list that you get from studentaid.gov, then those are going to be your private loans, because the printout from studentaid.gov will have all of your federal loans. Though I should note that it's possible that you'll come across loans out there in the world on your credit report or somewhere else that you just completely don't recognize. And those are probably private loans, but in the instance where you don't recognize a loan, there could be an issue of identity theft. So you should ask for more information and flag for the credit reporting agencies and pursue that just in case. Okay, so now that we've seen these loan details in action and the differences, I'm going to bring back this slide just so that you can see again how FEL loans might be owned, although they're federal loans, privately or federally. So again, just to emphasize that this is sort of complicated, but hopefully we're going to walk through it together. So, why does this matter? What's the difference between these loans? So generally speaking, federal loans, regardless of who owns them, will have access to all sorts of congressionally required and mandated repayment options and borrower protections, which we'll be discussing today. While private loans, generally speaking, really only offer the options that the lender chooses to, either in the terms of the loan or later on. For default and collection practices, there are differences between private and public loans, and whether or not your loan is owned by the federal government ended up being a major part of the pandemic relief, which we'll discuss. So there are some differences, and we'll talk about that during the webinar today. So now that we know the difference between loan types and how to identify what loans you have and who owns them, we're going to talk about what that means during the pandemic and during COVID-19 and the CARES Act. So in March of 2020, when Congress passed the CARES Act, it included a suite of protections for student loan borrowers. These protections have been extended several times by the White House and by the Secretary of Education and are currently set to expire on September 30th of this year, so just in about 2 months. That relief includes a reduction of the interest rate for covered loans down to 0%, so no interest has been accruing on these loans since March of 2020. It also includes a automatic suspension of payments. So no payments are required on these loans, although you can make voluntary payments if you're trying to pay down your balance. For these covered loans, for those folks who are seeking loan forgiveness through public service loan forgiveness or income-driven plans, which we'll talk about both today, these months since March of 2020 of non-payment actually count as credit, as if you had made a payment towards that loan forgiveness. And if anyone has been in default or is experiencing involuntary payments and collections, such as wage garnishment or offset of your tax returns, tax refunds or other benefits, that has also stopped since March of 2020 and through currently September 30th of this year. So now the question is, who gets this relief? And this is where that distinction earlier comes up. So it's only those borrowers whose loans are owned by the federal government. So here we see it's only direct loans, government-owned FEL loans, and certain privately held loans. So now, again, you see why we took time to walk through that. In March of this year, for that certain privately held FEL loans, the pool was expanded to include any of those privately owned FEL loans, those privately owned federal loans, who have entered default since COVID started. So what those loans in default, they were moved over to the federal government, to the Department of Education as the owner, returned to good standing, and added to this payment pause. So that was just a few months ago in March. So generally speaking, at this point, it's July of 2021, and this has been happening since March of 2020. Most folks should be aware of whether their loans fall into this. But if you're not sure, now you know how to go on to studentaid.gov and check your loan type. And if it says lender, the U.S. Department of Education, it's going to be covered by this extended relief through September. So again, only those loans on the left-hand side here are getting this pandemic relief currently. So what do you need to know about when payments are going to resume? They're currently scheduled to resume after September of this year. That could change. We don't really know. There's a lot of pressure for the government to extend the repayment pause. But what do you need to know to repair? So a couple things. So you should definitely update your contact information or just double check. Many people have had to move over the past year and a half, and you don't want to miss any of the notices that'll be going out about payments resuming. And when payments do resume, you should get your statement for your next bill about 21 days before the payment is due. So you should be keeping an eye out for that and make sure that they have the right contact info. If you did make a voluntary payment during this payment pause, you can request a refund. And also payment should resume to be the amount that you were paying when the pause started. So if you have already enrolled in an income-driven repayment plan, the recertification for those have been pushed out past the payment pause. So you should return to the income-driven amount and get a notice for when you need to recertify. And we're going to talk about income-driven plans and recertification later today. If you haven't enrolled and are worried about the affordability of payments when they turn back on, you can apply now for income-driven repayment options during the payment pause, the remainder of it, and we'll discuss that. Finally, if you've had any automatic payments set up from before the pause, the automatic payments aren't being drawn right now. There's this pause in effect, but they will resume after September 30th or whenever payments resume. So if that's a concern for you, if you don't want payments to automatically come out and you already have that set up, you should go in and manually turn that off. And you should do it as soon as possible, but at least 3 business days before your next scheduled payment is due. Okay, so since the payment pause only covers federally owned loans, let's briefly talk about options for privately owned loans, both federal and private student loans, those that were on the right-hand side of the chart. So for privately owned federal loans, you can still access repayment plans like income-driven repayment, which we'll discuss, and get that lower monthly payment if you're struggling with repayment. For private student loans, unfortunately, there aren't any uniform options that are required for these private loans. Each lender can more or less offer what they're willing to. And there was a time last year where coordinated lenders with state involvement were offering sort of a shorter 3 or 4 month version of the payment pause, but a little bit different. So you should reach out to your lender and your servicer if you're having issues and ask them what the options are. There's a list here of some things that might be available to you, such as interest-only payments. Or short-term forbearances where payments won't be due, but interest will generally tend to accrue. And that might just be, they'll give you a forbearance or they might ask you to document a hardship. It depends. So you'll have to ask what's required. If you do get any form of relief from your lender, you should confirm with them how it's going to be reported to the credit bureaus. You don't want it to be negatively reported that you're paying anything less than your normal amount. What you want is for it to be reported as paid as due or paid as agreed, since you're making a payment that the lender agreed to accept. And if you apply for relief that they say is available and are rejected, you should ask why and get it documented, because if you were denied for bad reasons or improperly denied, you're going to want to be able to document that and appeal it. And you can file a complaint here with the Attorney General's office or some of the CFPB or some other state offices. And in general, it's always a good idea to get things documented. So if your lender tells you something on the phone, you should ask for it in confirmation in writing. Okay. So in addition to the payments resuming for millions of borrowers after September 30th, unless payment pause is extended, there's another major change coming up that I want to let you all know about, which was just announced, and which will also have an impact on millions of borrowers. So just this month in July, one of the largest federal loan servicers, FIA, which does work for federal loans as Fed Loan Servicing, and another smaller federal loan servicer, Granite State, announced that they will not be continuing their contract to service federal loans after it expires on December 14th of this year. That's their contract with the Department of Education. So this is significant for a couple of reasons. First, all of their federal loan accounts will have to be transferred to another servicer or servicers. By our calculations, this represents 31,800 borrowers in the district alone in DC. And we know from in the past when there have been large servicing transfers that errors are probably going to happen. And that might look like incomplete accounts getting sent over, payment history is not completely being shared. And that can cause major problems down the line for borrowers who need to document eligibility for certain programs or for loan forgiveness, among other things. Another major issue is that FIA is the exclusive servicer for the public service loan forgiveness and teach grant programs. Which means that public service workers will be disproportionately impacted by this transfer. So this is a very recent announcement, just 2 or 3 weeks ago, and there still isn't much that we know about the transfer of either of these servicers. So again, there are a couple things you can do to prepare yourself for this transition if you are going to be impacted. And we've discussed how you can go look at your federal student loans on studentaid.gov, and you should be able to see your servicer there to see whether you have FIA, Fed Loan Servicing, or Granite State. So as with before, you're going to want to make sure your contact information is up to date. People have been moving around, but you don't want to miss these notices if you're going to have to start making payments to a new company. Also, you're going to want to get a complete record of your account just in case there are some issues with the transfer, and you want to do that soon while it's still with your original servicer. So you can do this by going online and downloading as many records as you can. But even if you do that, you should contact your servicer and request a complete copy of your account, including any payment histories and any history of eligibility for loan forgiveness. So if you've been working towards public service loan forgiveness, like we'll discuss later on today, there should be documentation of that, and you're going to want them to send you a complete record of that. You should keep this in a safe place so that if down the line you need to document something, that you know where to go and you can produce those documents. Finally, if you encounter an issue, you should file a complaint. This is definitely one of those sort of see something, say something situations, and you can file it again with the Office of the Attorney General, with the CFPB, or with the district student loan ombudsperson over at the Department of Insurance, Securities, and Banking. Don't assume that if something happens to you, it's not also happening to someone else. So again, see something, say something. Okay. Unfortunately, we still have a lot of unanswered questions, both about repayment or payments resuming and about the transfer of these accounts. So first, as I'm sure you were all aware, and as the Attorney General alluded to, there's a big conversation right now about debt cancellation and whether the Biden administration or Congress will take action to wipe out federal debt or just to fix some of the problems with the system, but certainly to cancel debt. Will this happen? We're still waiting. But as the Attorney General mentioned at the start of the call, there is a broad call for this kind of debt cancellation. Now, debt cancellation, we got some questions in advance, would probably look different for folks whose loans are owned by the federal government versus those that are privately owned, and certainly different for those who have private student loans. We'll have to see, and people will keep calling for relief, but private student loan debt forgiveness will probably be different and may not happen on the same time frame, if at all, as federal student loan debt forgiveness, since the federal government has a much closer control over the federal loans as opposed to privately contracted loans. We also don't know if the payment pause will be continued past September 30th. Clearly, we have not beaten COVID, and millions of borrowers are still struggling economically. And this is especially true as eviction and foreclosure moratoriums are about to come to an end in the district and across the country. Also, with which servicers are going to take over for FIA and Granite State, we don't know the answer to that. And in general, will all servicers be ready to turn payments back on either after September 30th or later? And will they be prepared in terms of staffing for the inevitable increase of customer service requests? So the government and groups like the Student Borrower Protection Center are pushing out information as it becomes available. So you all really need to make sure you're reading notices, following the news, and staying vigilant for updates about this. Okay, so we've discussed how to identify your loans and the current state of repayment for most types of loans. Now let's talk about repayment options for federal loans. These are relevant both as a way to navigate payments once they resume, either later this fall or later, but also generally for anyone who's been struggling to make payments and struggling with their loans. And what we're going to talk about in this next section is specific to federal loans, sort of regardless of who owns them. So for federal loans, you have a number of repayment options. They generally default to the 10-year standard plan, which has set monthly payments for 10 years until you pay down the loan. There are also extended plans, which is a lower fixed payment for a longer period of time until you pay down the loan, or graduated plan where it's a 10-year term, but you start with low payments and you end with higher payments than the standard plan. So you still pay it off over 10 years, but they step up the amount that you pay. So we're going to spend most of our time talking about the final bucket of repayment options, which are called income-driven repayment or IDR plans. So there are several types of IDR plans, but their common features are that they set your monthly payments based on your current income and are designed for the payments to be affordable. If you have low or no income, you can qualify for payments of $0, but those will still count as payments. So you're making a $0 payment, but aren't falling behind. It's counted as a payment. Another feature of IDRs is that they offer a certain number, or after a certain number of years, the remainder of the loan that's left will be forgiven. And that's typically 20 or 25 years for IDR plans. As we'll talk about soon, if you're doing public service loan forgiveness and paying through IDR, the remainder of your loans will be forgiven after 10 years, not 20 or 25 years. Now, importantly, Generally, that forgiven loan amount after 20 or 25 years is considered taxable income at the end of the day for income-driven repayment plans, which is not the case for public service loan forgiveness, but for these plans after 20 or 25 years. But earlier this year, the Biden administration passed a law that makes the debt forgiveness for these plans tax-free until the end of 2025. So we'll have to see if that is made permanent. I'm sure there'll be a lot of pressure to do that, but we just don't know yet. But that's something to be mindful of. So the major types of income-driven repayment plans are listed here, and they've been added over time by different administrations. And frankly, it's a very confusing network, which you'll see in a moment, but they're called income contingent repayment plans, income-based repayment plans, pay as you earn or pay, and repay as you earn or repay. So I mentioned that the payments are intended to be affordable for all of these. And there are specific calculations for each plan to set the monthly payments, which are generally 10 to 15% of your discretionary income, which is calculated as the difference between your adjusted gross income and 150% of the federal poverty line for your family size. So this is how borrowers can end up with a $0 payment if they have a low or no income. For married borrowers who file their taxes jointly, the entire household income will generally be taken into consideration, whereas for married borrowers who do not file jointly with their spouse, the plans vary as to whether or not they take the spouse's income into consideration. For example, repay requires both, regardless if you're jointly or filing separately, whereas pay and IBR, income-based repayment, only require the borrower's spouse if they file jointly. So the Department of Education on their website has a repayment estimator that you can use to see what payment you would likely pay under each of these plans. So that's a tool that's worth using and you can access on their website from studentaid.gov. Now, not every federal loan is eligible for each IDR plan. Again, you can visit studentaid.gov and you should speak with your servicer or contact a nonprofit counseling agency to get more information on which IDR plan you are eligible for. The nuances are very important, but are a bit too complicated for us to really drill down into on a large format webinar like this. Generally, however, pay and repay will be the best option for an eligible borrower who's looking for the lowest monthly payment. FEL borrowers with those older loans, if you remember, will only be eligible for one type, the IBR plan. Also, some plans require a showing of hardship or partial hardship, financial hardship, to be eligible to apply initially, but then once you're in, you can generally stay in even if that hardship ends in that plan. Some plans will cap the amount that you'll pay each month at the same as if you were making the standard plan. So if you're high income, 10% of that, if that was over the regular standard plan, they'll cap it there, but some don't. If you're high income and you're paying 10%, it might be a larger or higher monthly payment than the standard plan, but you're working towards forgiveness, which is good. Some plans offer short-term interest subsidies for certain loans called subsidized loans, where the federal government will pay any portion of the interest that's not covered by the lower monthly payment, which we'll talk about in a moment. And if your loan isn't eligible for any of these plans, then you can modify the type of loan you have through a process called consolidation, which is essentially refinancing your federal loan with the federal government to become eligible. So for instance, Parent Plus loans are generally not eligible for any of these plans, but if you consolidate them, they can become eligible for some of them. You can also generally switch plans at any time, but some plans like the income-based plan, IBR, will require you to switch to the standard payment first before switching somewhere else. So again, as you can see, this is complicated and picking the right plan isn't always very easy. We'll talk in a moment about, as you enroll, an easy way to get an affordable option. But I do want to stress that you should, study the different plan options, talk to your servicer, double check what kind of loan you have. And as you talk to your servicer or a loan counselor, you should ask them a couple important questions, like what is the maximum you'll ever have to pay? What happens to unpaid interest in each plan for you? What are you eligible for? And what happens if you leave the plan, et cetera. So in addition to the direct benefits of IDR, such as lower monthly payments and ultimately getting loan forgiveness, there are several indirect benefits. So the data bears out that IDR borrowers have better financial outcomes than non-IDR borrowers, including with their other consumer debts. So they don't fall behind as much on their other debts, and they may actually increase their ability to access other forms of credit. So IDR is a very powerful tool for managing your household finances, especially if you're concerned about long-term affordability. So there are some things, however, that borrowers need to know and should be aware of for IDR. And the first is something called negative amortization. So essentially, some IDR payments are so low that they don't actually cover the monthly interest that accrues. And that means you have unpaid interest each month. That doesn't mean that you fall behind or are considered delinquent. This is, all part of the IDR plan. But it does mean that interest adds up. And there are some events that can cause that accrued interest to capitalize, which means it's folded into the principal of your loan. And interest will start to accrue on that larger amount. It's sort of like an interest on interest, and the outstanding balance will grow. So that's what negative amortization is. Over time, your loan gets bigger, not smaller. So leaving one of these IDR payment plans and or failing to recertify on time, and so getting sort of booted out of the plan, can cause this to happen for some of them. Now, for folks who plan on debt forgiveness, as opposed to paying down their debt, you just need a long-term way to make affordable payments and then hope to get forgiveness. This shouldn't be a huge deal because all of that debt, the capitalized interest, the negatively amortized amount, will be forgiven at the end of the day. But if something happens and your circumstances change and forgiveness is no longer your plan and you want to pay it down, if you've had negative amortization, you will have to pay down a larger amount over the life of your loan. But although the loan debt does grow, it doesn't necessarily have a negative impact on your credit. For underwriting and credit purposes, your lender should report these lower payments as paid as agreed or in good standing, since it's an agreement, even though it's less than the standard amount. And if you're trying to access new credit, underwriters will generally look at your monthly required lower payment as what you're obligated to pay and whether you're current on that and what your household expenses are based on that, not the outstanding huge growth of your loan. Okay, so if IDR makes sense for you, how do you enroll? What's the process? So there are some things you're going to want to have on hand. So the first is your FSA, or Federal Student Aid ID. That's your login and credentials, basically, for studentaid.gov and how you access the portal for your federal student loans. You're also going to have some personal information on hand, like contact information, but also household composition and just some additional info. And then you're going to need proof of income. This can be based on your last tax filings or pay stub from recent pay stub. Or if you have alternative payment frequencies, a letter from your employer or employment statement or something like that. So you can enroll online or by paper. And on the application, you can specify, and this is what I was referring to earlier, you can specify a specific plan you want if you've done the research and or you can say that you want the lowest cost monthly plan that you're eligible for. And that's sort of recommended for folks who aren't sure. So you'll see that represented on the screen here. You can make that choice instead of having to select a specific plan. For the online payment, again, you can go to studentaid.gov, and then under the Managing Loans tab, you'll see an option for information about IDR and also to apply. So this is where you go both the first time you apply and as you have to recertify your information each year, which we'll discuss. The online application will guide you through the process. If you're married, you'll need your spouse there to sign on to certify some of the information. By doing the application online, you can automatically import info about your income from the IRS if you file taxes recently, and you can have the application automatically sent to your servicer. So it's a pretty quick and a pretty concise process. If you have limited internet access or just prefer to apply by paper, you can download the IDR application or ask your servicer to send you a copy. You'll need to fill it out and attach the income verification documents before you send it in. Now, both online and on paper, if you have no declarable taxable income, you can indicate that by sort of self-attesting to it with a checkbox, as opposed to having to sort of prove the negative, right, of what your income is. So some things to keep in mind, with IDR, there are a few things to be aware of. So the first is that you need to recertify every year. If your income has changed, your payment likely will change. It'll go up or down, depending on whether your income goes up or down. You'll also have to confirm your family size because that's part of the calculation for your monthly payment. You can also recertify whenever. It doesn't have to be every year, every 12 months. That's just when you have to, if you certify, you at least have to do it 12 months later. But if you have a change in jobs, if something happens, you can recertify at that point. You also, and it'll be good for another 12 months. So you restart the 12-month clock. You also keep in mind that the process takes time. So if you do not recertify in time, you can get removed from the IDR plan, and that can return you to the standard repayment option beforehand, whether or not it's affordable to you, until you reapply for IDR. If you submit your papers, and you'll get notices about your deadline, but if you submit your papers within 10 days of the deadline, you should have your lowered payment maintained until your new payment amount is determined. So sort of an administrative forbearance situation there as well. But leaving an IDR plan can cause that accrued interest to capitalize the negative amortization we were just discussing. So there really are some ramifications to going off and on an IDR plan or to missing a deadline. So if you're experiencing like a short-term income shock, you might want to explore something called a deferment, which can defer having to make monthly payments for a short period of time. There's also something called a forbearance, but you should look into deferment first. Forbearance can have that interest capitalization effect that we discussed. And that might be a better tool for you in the short term than IDR. But if you're having long-term affordability concerns, let's say you're in a career or a job where you don't anticipate making much more and you currently can't make the full payments, IDRs are going to be a better fit because that's going to give you the long-term affordable option with that opportunity for loan forgiveness in the end. And as I mentioned a few seconds ago, if you're already in an IDR plan and your income goes down or you're laid off or something, you can recertify in that moment and get a lower payment that's good for 12 months, even if your income goes back up or you get a new job during that 12 months. That's totally fine. You don't have to sort of claw back or repay anything later on. You're good for 12 months with whatever you certified as long as it was accurate at that time. And if you're consolidating that process of refinancing with the government, you can consolidate straight into an IDR plan so that your first payment will be based on your income and hopefully will be affordable. Okay, so there are a few ways to manage your loans if you're struggling with repayment. And we just discussed those. But if you've already had an issue and you're in default, I'm going to cover some strategies for getting out of default. So for federal loans, default is defined as 270 days past due. For private loans, it's going to depend on the terms of your contract. It can be one payment, it can be multiple payments, but you'll have to look at the terms and it varies. So unlike private loans, where creditors have to go to court and get a judgment before they can take money from you involuntarily, federal loans have extraordinary collection provisions and powers. So if you default on a federal loan without going to court, the federal government can garnish your wages or offset your federal benefits and tax refunds. They do have to send you a notice first with a time period and an opportunity to raise claims against being collected upon, but there are really very few that will prevent collection. Unfortunately, merely not having the money to pay is generally not sufficient. So the government will also, if you're in default, send negative reports to credit reporting agencies. You have to remember, for the federal loans that are covered by the current payment pause, those that are owned by the federal government, these practices are currently suspended, but they will come back when the payment pause lifts. So beginning currently October 1, if someone is in default or falls into default with a federal loan, they may be subjected to these garnishments or offsets. So there are two ways to get out of default with a federal loan. You can consolidate, which you'll remember is essentially refinancing with a new federal loan. You can take out a new loan to pay down the defaulted old loan. Or if you're consolidating, if you do that, you're required to consolidate straight into the IDR plan. As I mentioned, you could, so that the payments are affordable. But if you're already under garnishment, you generally cannot consolidate. But you have another option, which is Rehabilitate, which is basically a payment arrangement to get out of default for your existing loan. You can consolidate online, and it's relatively quick. Again, this doesn't repair your current loan, it replaces it. If you're experiencing garnishment, this will be the fastest way to stop that. If you're at the risk of garnishment, I should say, this is the fastest way to get into good standing with your new loan. A downside, though, is that if you've already accrued any credit towards loan forgiveness through IDR public service, you could lose that because you're paying off that old loan and taking out a new loan. So it doesn't have that same credit built up. For rehabilitation, on the other hand, you should work with your servicer to figure out what will be an affordable payment plan. This rehabilitation works by making 9 affordable payments in a 10-month period. And for that, they'll take into account both your income and your expenses to determine what's affordable. And it could be as low as $5 a month. So again, if you make 9 of those payments within 10 months, you'll be restored to good standing. If you're already being garnished, the garnishment will stop after month 5. Though during those first 5 months, you'll be garnished and have to make the affordable payments. The garnishment does not count as the 5 payments to stop the garnishment. Once you've been rehabilitated, you can resume regular servicing and payments on your loan. You're back to good standing. If you think at that point staying current will be difficult for you, you should then explore income-driven repayment plans, right, to get that lower, hopefully more affordable payment option. Another benefit of rehabilitation that consolidation does not have is that once you complete it successfully, the default of that loan will be taken off your credit history. The delinquency, however, leading up to the default, those 270 days of missed payments will remain on there. So for anyone who has a defaulted loan that's owned by the federal government, another important thing is that during the payment pause, you can get credit towards rehabilitation. Each of those months can count as the affordable payment, even though it's $0. But you need to have enrolled in this. So even though there's only a few months left in the current payment pause, if you're someone who's in default, you should talk with your servicer or the company that's handling the defaulted loan for them to start the rehabilitation. It'll eventually restore you to good standing. And if the payment pause is extended and if they choose to continue giving credit for the extended months, you'll be well positioned to get those credits. So how many times can you do this, right? If you have successfully rehabilitated, you can't do it again. You can only successfully rehab once. But if you didn't complete it, if you didn't do all 9 payments, then you can keep trying. To consolidate, you generally need, like the name suggests, to have more than one loan that you're consolidating into. So it depends on your circumstances. There are some situations, however, where you can consolidate one loan directly into another consolidated loan without actually having to bring in another option. And again, you can request a hearing if you are subject to collection to stop it. And there are some limited instances of listed here to get some short-term relief, but longer term, rehabilitation and consolidation are going to be your best options here. I should also say that there's always the opportunity to sort of negotiate out of the box with how to repay or pay off your federal loan, but it varies, and consolidation and rehabilitation are really going to be the main options. Okay. So that's federal loans. What about private loans? If you've defaulted on your private loan, you should still speak with your servicer or lender to ask about repayment options. Again, there's not a requirement that they offer certain things, but you may be able to negotiate a total amount owed that's a reduction. You should always get it in writing just to make sure you have things documented. But ultimately, they're going to have to take you to court and get a judgment against you if they want to collect. So if you're sued, you should contact a lawyer promptly because you have a limited amount of time to respond and show up in court. And there are always going to be defenses to a lawsuit against you. So for instance, there's a statute of limitations for private loans, which means they only have a certain amount of time to sue you. If it's passed, they can't sue you and you shouldn't have to pay them. Also, if you used your loan to go to a school that defrauded you, you may not have to pay back that loan. Or if the loan charged you an unlawful interest rate, it may be void and you don't have to pay it back. So these are all very legal, technical defenses. So if you are experiencing private student loan collection or lawsuit, you should contact an attorney and you should file a complaint with the Attorney General's office if you're being harassed or abused by the collector. So in advance of today's presentation, we got some questions about bankruptcy. We'll just talk about this very briefly. There is a myth that student loans cannot be discharged in bankruptcy at all. That is not true. It is true, however, that most student loans have a higher threshold they have to overcome to be discharged in bankruptcy. So that includes all federal loans and private student loans that were used for tuition and certain other expenses at certified schools. The loans you took out just while you were a student to pay for other things are not necessarily considered student loans for the bankruptcy purpose. Again, this is very complicated. It's very legal. But if you are struggling with your finances generally, considering bankruptcy, which can be a very effective tool for getting a fresh start, you should consult with an attorney and just know that there's not a categorical bar against discharging your loans in bankruptcy, your student loans, but you need to really review the specifics of your loans. Okay, so our final topic is something that I think is really relevant for this crowd, and that's public service loan forgiveness. So put simply, Pslf, or public service loan forgiveness, is the promise that if a borrower works in public service and makes payments for 10 years, the remainder of their debt after that will be forgiven. And unlike how it typically works with income-driven repayment forgiveness, that forgiven loan is not taxable income. You're just done. But as we'll see, unfortunately, it's a bit more complicated than that. And this program has not worked out the way that it was designed to. And there's actually a lot of attention on it right now. So first, I'm going to explain how it works. And then I'm going to talk about some of the issues and then what steps you can take for yourself with Pslf. So how does Pslf actually work? More than just simply working in public service for 10 years, there are 4 specific criteria. First, you need to have a direct loan. That's that federal loan type we mentioned. Second, you need to be in the correct payment plan, which is generally IDR. Third, you need to work in a public service field. And finally, you need to make 120 qualifying payments, so 10 years worth of payments. So I'm going to drill down into each of these. So only direct loans qualify for public service loan forgiveness. Direct loans have been the main federal loan since 2010. So if you've taken out a loan since then, it's likely a direct loan that qualifies. But if you have an older FFEL loan or a Perkins loan, these do not qualify. What you can do though is you can consolidate those loans into a new direct loan that'll then qualify, which you can do online. It's the same consolidation process we discussed for getting out of default, and it's relatively quick. You can usually be done within a month. But since you're essentially taking out a new loan, again, you'll have lost any credit in time that you had on those older loans you were consolidating. Still, for some folks, it's worth it because otherwise you may not have qualified. So it's important to know that when people get rejected for PSLF, it's often because they had the wrong loan and didn't know it or something like that. So it's worth looking at and seeing if you have to take any steps, but we'll talk about that. Second, your direct loan needs to be in the right payment plan, which is generally IDR. It doesn't matter so much how much you're paying, so much as that you're in the right plan. The 10-year standard plan can also work in some instances, though since PSLF is forgiveness after 10 years, it's sort of at that point, you're kind of just paying down your loan. The extended repayment plan, which is the lower fixed amount over a longer period of time, does not qualify, and certain months payments for the graduated plan where it steps up will qualify. But in almost all instances, you're going to want to be in the IDR plan in order to qualify for PSLF. Third, to get public service loan forgiveness, you need to work in public service, right? So the focus is actually on your employer, not on your role. You can work at a government organization, so a district employee, for instance, or city, state, and federal employee, work at a 501c3 nonprofit or certain other nonprofits. You have to work there full time, or you can work for multiple qualifying employers for at least collectively 30 hours a week. You'll just have to document it for each employer. Certain tasks, however, and the hours associated with those tasks are not, you can't count towards your forgiveness. So, and that's mostly things around religious activities as listed here. So finally, the fourth criteria is you need to make 120 of these qualifying payments, on the right loan, payment plan, and with the correct employer. The payments have to be made in full and on time, and only recently did they start to allow lump sum payments, but only up to a year at a time, and that's paired with the IDR recertification. So if you make the equivalent of 12 IDR payments at once, it can count for 12 months of credit, but only up until you recertify, and then you would have to do it again. The payment allocation to make sure the account can get very complicated. So you want to be very clear with your servicer. If you're doing anything other than just a regular monthly payment, you want to be very clear that you hope to have this count for public service loan forgiveness, get them to document their answer to you, and then proceed sort of with caution there. If you leave public service and come back, you don't have to restart 120. You can pick back up wherever you left. It doesn't have to be consecutive. Okay, so what's the actual process for getting forgiveness? Your employer and you need to fill out what's called an ECF, or an employer certification form. As I mentioned earlier, FIA or Fed loan is the exclusive servicer for public service loan forgiveness. So borrowers seeking PSLF need to send the ECF to FIA, which will do a preliminary review for eligibility and then transfer the loan over to Fed loan for servicing, transfer it to itself, and then continue to review for other eligibility criteria. So now you can see why the transfer of FIA Fed loan is going to be such a big deal, because they're the exclusive Fed servicer. Unfortunately, there have been a lot of problems with people finding out too late in the process that there's some eligibility requirement that they aren't meeting. And for this reason, we really recommend that you do an ECF every year for your qualified employment. And that way you can catch anything along the way. You don't have to do this. The program does allow you to do it at year 10. But if you do it each year, you're getting a sort of a check-in that you're meeting the criteria, and if there's an issue, you can fix it. So another important note is that another example of how this program is more complicated than it really should be and is missing the point is that you currently need to still be working in your qualified public service job to get the loans forgiven. So that means that even if you applied and are waiting, you can't change your job or retire. You need to be in the qualified job when the forgiveness is granted. So, you can imagine it's very frustrating part of the program, and frankly doesn't make a lot of sense, but it's important to know. And this is all the more frustrating because there's a huge backlog of PSLF applications. So some folks at least are having to sort of wait it out while their application's reviewed before they can move on with their career or retire. So there are some impacts of COVID on the PSLF forgiveness program. First, these loans that are getting the payment pause, those covered loans owned by the federal government, for each month of the suspended payments, it counts as a qualifying payment if you meet the other criteria, right? So it has to be the right loan, the right employment, the whole thing. The four that we said, it's just that one factor. Many nonprofit budgets were really cut though. So if folks lost their job or reduced their hours, they're not getting that employment criteria hit. So even though the month will otherwise qualify, it's not qualifying for them. And although we can't say for certain, it's likely that COVID has impacted the backlog. And so that's another frustration from COVID. For folks who, because of COVID or remote work, would have liked to retire, but can't because they have to stay in that job until they get cleared for their forgiveness, COVID is also adding to that. So COVID and the payment pause helped some people with free credits, but have also been a frustration for other people who've been impacted in their employment. All right, so with the time we have left, I'm going to finish out this topic just to say that Pslf really hasn't been working as it was supposed to, and I alluded to this. It may have been an understatement to say that it's really not working very well. So the program was created in 2007. So the first class of 10-year people only started in 2010. And after 10 years, we started to see that the outcomes. And the initial rejection rate was 99%. Only 800 or so of the initial 90,000 applicants were approved. People were being denied because they had the wrong loan, or they were in the wrong repayment plan, or someone gave them advice partway, 6 years ago, or some other technical reason that really has nothing to do with whether they worked in public service for 10 years. So as you can imagine, that's a huge problem, and it's an incredible, failure of this promise of loan forgiveness for public service workers. Many folks took out debts relying on this promise, and it's not working out for them. So Congress acted and created the temporary expanded Pslf, which was a special fund for folks who'd been rejected. The program only really made one change to the regular program, which was that if you had the right loan with the wrong payment plan, you could qualify under TE Pslf. You still had to meet everything else. So if you're a teacher with a FFEL loan, this doesn't do much for you, even if no one told you you need a direct loan. And unfortunately, under TE Pslf, the initial rejection rates were just as bad at 99%. So there's a huge problem here, right, that needs to get fixed. Here in DC, the rates were a little bit better. The Pslf rejection rate was 92%, and the TE Pslf rejection rate was 64%. So currently, you can apply for Pslf and TE Pslf together and get reviewed for both. And some people are getting their loans forgiven. It's getting a little bit better. And there's currently a lot of pressure to make the program work, just make it work, get over all these bureaucratic hurdles. So I encourage you all not to get too discouraged, but to take the information you've learned today and to check in on your eligibility and to make sure that you're working towards forgiveness for your loans. In addition to working towards your own forgiveness, I also want to urge you all to share your experience. So with Pslf. So just this week, on Monday, actually, the Department of Education, for the first time ever, opened a request for information and is formally seeking input from borrowers to tell them about their Pslf experience. This is a huge opportunity and a great chance for borrowers who've worked for 10 years in public service, but who aren't getting loan forgiveness because of some small program criteria, or someone who's delayed retirement to get their extra qualifying payments, to ask the Biden administration to fix the program once and for all. 10 years of service should be 10 years of service, and then you get your loans forgiven, regardless of the type or plan. So that was the promise, and it hasn't worked out. The comment period is 60 days starting this week, and I put a link here to an online form that you can use to share your story, and then it'll format it in the right way that it can be submitted to regulations.gov and added to the comments. There have been thousands already. And so again, in addition to taking steps to manage your own loans and get caught on the, get on the track for forgiveness, I think you should take time to call for this broader change and make sure that public service workers are getting the forgiveness that they were originally promised. Okay, so in summary, I'm just going to talk about the main things that I hope you can use and bring to bear in the coming weeks. Okay, so you should know who's going to be impacted, right, when the payment pause ends. And if you're a FIA or Granite State servicer, you also, or borrower, you should also know your accounts may be transferred. And now you know how to go online and see what loans you have and who your servicer is if you weren't sure. You should contact you should update your contact information to make sure you're getting all the notices you need. If you are going to have your account transferred, you should go and download and then call and request all of your account records. If you're struggling to make repayment or concerned about payments turning back on, you should explore income-driven repayments, and you don't have to wait to apply. You can just go ahead and do that. And finally, in addition to checking in on your own Pslf eligibility, you should share your story and share this opportunity with your friends and family and anyone who you work with who might be impacted by this. Really, it's time for the government to sort of pay up on its promise for public service loan forgiveness, in addition to the broader call for debt forgiveness. Okay, so with that, thank you all for sitting through this presentation. We do have a few minutes for questions. I know that this can be hard in a large format and it can be difficult to answer sort of very individualized questions, but I'll turn things over to Lauren to see if there are some questions in the chat box that we want to address. I'm going to come out of my presentation mode to do that.
Sure. Thank you so much, Winston. So we only have a little bit of time, and there were dozens and dozens of questions that were put into the chat. And so our hope, this was a webinar to kind of give an overview of student loans kind of in anticipation for COVID reliefs kind of ending fairly soon. So our hope is that we're going to continue to have these types of webinars where we can kind of delve into some more of your questions. But just really quickly, there were a lot of questions about Parent Plus loans. Is that included? What are the repayment options? Can there be a payment pause? What do parents who have Parent Plus loans qualify for Pslf? If you could speak to that.
Yeah, and I'll try to succinctly hit all that and because it is very complicated and very frustrating. So Parent Plus, very broadly, does not automatically qualify for a lot of the forgiveness and income payment options that we discussed today and that are really so important. But what you can do is you can consolidate your Parent Plus loans into a direct consolidation loan and access repayment options for that direct consolidation loan. You can then go a step further, and this is getting a little bit too wonky, but then you can, if you have the loans to do it, further consolidate that consolidation loan and access even more options. So the short answer to that very frustrating question is there's not a ton of options for Parent Plus loans directly, but don't let that stop you. You can consolidate if that's going to make sense for you with that new loan, and then access more repayment options.
And then another question that came up a bunch before I turn it over to Ben was there are some people who were either in the application process for loan forgiveness, or they were applying for it, or they were in it, and then COVID hit. How do they know if they need to resubmit their application, or does it still apply to them even though COVID happened and everything was suspended?
Yeah, so the payments were suspended, but the servicers should still be reviewing applications. It's a little complicated, right? Because you're applying for something if it's a lower payment during a time when you don't have to make payments, but certainly for any debt forgiveness, the application should be reviewed. So the first thing you should do is ask your servicer for a status update. And you should get that in writing. And you should ask that, especially if you're one of the two servicers who's going to have an account transfer, you should also ask for the entire account record that shows the status you're at. There's no reason why your application should be interrupted. So there's a problem happening, right? If you're going to fall between the cracks. So you want to get it as documented as possible. If you're not getting a satisfactory answer, you should file a complaint with the Office of the Attorney General or with the ombudsperson at DSB.
Okay, thank you for that. And I'm not going to be able to get through all the questions right now, because again, there were so many that came in and there's a flood of them right now. So I'm going to turn over to Ben really quickly before we finish for the day.
Thanks, everyone, and thanks, Lauren. Thanks, Winston, for the great presentation. One quick question is, where can folks access the employee certification forms? That should be it.
Yeah, so all of that information, studentaid.gov is going to be your first and often one-stop shop for all of this information. So if you haven't spent time there, it's actually pretty comprehensive in answering most questions. So I would spend time there, and they have copies of all of those forms there, studentaid.gov.
Great. Thanks, Winston. And we know a bunch of you have been asking questions in the chat. We're going to save those questions. We'll try to follow up with you. You can also, again, file a consumer complaint or email us at consumer.protection@dc.gov. If you have any more specific questions, we'll work with the folks at the Student Borrower Protection Center, see if we can try to get you answers or direct you to the right place where you can get answers. Once again, thanks everyone for joining. We know this is such an important issue for so many folks. Winston, that was a great presentation. Thank you, and have a good weekend, everyone. Stay safe.
And just lastly, really quickly, that I will make the presentation available, at least the PowerPoint slide. And so I will send that out. If you don't receive it by Monday, you can email me at lauren.haggerty@dc.gov, and I'll put that in the chat for you all. And thank you so much, Winston. Thank you so much, Ben, for excellent presentation today.
Thank you all. Have a good weekend.